Hi, welcome back. I consider myself fair game for any question related to finance, corporate finance, valuation, portfolio management. You might not like my answers, they might not even be particularly good answers or well thought through answers, but there will be answers because I believe in answering questions. My philosophy in answering questions is I'd rather be transparently wrong than opaquely right. That said, for the last few weeks, I've been noticing an upswing in questions about Bitcoin, Ether, and cryptocurrencies. And I've kind of held back on my answers for two reasons. One is I've discovered that with cryptocurrencies, people fall into one of two camps. Either they believe that this is the future, and any answer you give to the contrary, they view as, hey, that can't be right. And on the other side, there are people who believe that this is a gigantic scam, that there's nothing behind it. I fall somewhere in the middle. And I'll start off by admitting that I'm a novice to cryptocurrencies. A novice in what sense? Well, I've never mined for Bitcoin. I've never met somebody who's mined for Bitcoin. I never even used Bitcoin. So, in a sense, you have to take that as the basis for what I'm going to say because much of what I'm going to say, you might, especially if you know a lot about cryptocurrencies, you might view as completely ignorant drivel. And that's what it is. So, I'm going to try to gather what I know about cryptocurrencies, which is not a whole lot, and bring them together in this session. Some of it will be far too basic for you if you've done this before, and some of it you might say, who cares? So let's get started. The success part of the cryptocurrencies is what they've done in the marketplace. Let's take Bitcoin. Bitcoin is a recent experiment. Recent in what sense? Well, it came into being at the start of 2009. It's been around for less than 10 years. Tough to believe when you think about how much popular mythology is built around Bitcoin. And since its start, it's soared. It's soared in what sense? The price per Bitcoin on July 31st of 2017, that was yesterday, was $2,775 per Bitcoin. So it's come from nothing to $2,775. There have been ups and downs, but clearly this has been a success story in the marketplace and lots of people have become rich. Now, if you're saying maybe it's faded, maybe it was just the first few years, that's not true because it seems to have picked up steam again the last 2 years. This is the price history over the last 2 years, and you can see again the soaring of the price of Bitcoin, especially in the last year. If you look at the yellow line, that is actually the number of Bitcoin out there, and that's a much more smooth series. It's a series that doesn't change very much. In fact, the number of Bitcoin in existence has increased from about 14.5 million to 16.5 million. More on that later. So clearly, Bitcoin has soared, markets have treated it very well. And it's not just Bitcoin. Here's a more recent entrant into the game, Ethereum or Ether. And if you look at Ether's rise, it's even more meteoric than Bitcoin. Coming out of nowhere, just in the last 2 years, the market cap of Ether exceeded 35 billion in June of 2017 before dropping back. I forgot to mention that the entire market cap, all of the outstanding Bitcoin in the world, is worth about 40 to 45 billion. So collectively, Bitcoin plus Ether at one point in time was, collective value was greater than 80 billion. Now, before we get too excited about those numbers, remember in the larger scheme of things, 80 billion is not a huge amount of money. I mean, after all, Apple has 250 billion in cash and Amazon adds about 80 billion in value to its market cap every year. But it is truly a rise from nothing that you've seen with the cryptocurrencies. So let's take a look at what the cryptocurrencies share in common. And that's the architecture that creates them. And this, to me, is the most creative part of cryptocurrencies, the part that might actually endure even if cryptocurrencies don't make it. And it's the blockchain. It took me a while to get my brain around this concept. So if I haven't got it quite right, please set me right, because I know there are people who know a lot more about this process than I do. So let's assume you decide to transact in Bitcoin. You decide to pay somebody in Bitcoin. So you initiate a transaction. What happens is that transaction gets broadcast to the Bitcoin network. You're saying, what's that? Those people who are in fact inside the network basically are the ones who keep it going. So when it gets broadcast to the network, the first step is to make sure it's a valid transaction. That's where the miners come in. You're saying, what's a miner? Well, much of the terminology in Bitcoin reflects its desire to be a replacement for gold. So the miners are the ones who check the transaction for validity, and then they put multiple transactions and they bundle them into a block. Now you're not quite there because this block has to be verified. You're saying verified by whom and by doing what? Well, the miners go to work and they basically solve a math puzzle. There's a hash or or a number that goes with the transaction. They solve for that hash, and before you get too caught up in you must be a mathematical genius to do it. This is more brute force than intellectual firepower. So with brute force, they basically find the key that unlocks that block, and once they've found the key, they let the rest of the network found that they found the key. The network checks and makes sure that the key works, and if it has worked, it's added on to the blockchain. You're saying, what's a blockchain? A blockchain is the history of every transaction related to that asset. So it's public, everybody can see what's in there. So the entire history of every transaction is in that blockchain. So that is the part of the process that happens within the network. And once your transaction gets approved and verified and made part of the blockchain, you're told your transaction is approved. You may say, how much time does this take? Surprisingly little, 8-10 minutes maybe less. And the successful miner gets rewarded. Rewarded with what? Right now, he or she gets rewarded with bitcoins or with ether or whatever the cryptocurrency is. More on that later as well. But this is the process. You're saying, what's different about this process? Here are the three things that make the blockchain what it is. The first is, for any transaction to happen, somebody's got to verify and trust it. So the way we've historically done this is there's somebody centralized to test it for us, whether it's, credit card. In a sense, with traditional transactions, we rely on centralized authority to verify transactions and to tell us the transaction works. With the blockchain, we essentially allow the network to check it for us. It's a shared testing. So basically, it's decentralized. Lots of people check it. So those people who are worried about centralized authority, this appeals to them. The second is, once a transaction is validated and made part of the block, everybody can see it. It's complete and open. There's no hiding from it. So that's the second feature, is everybody has access to that. And that is a good thing, right? In an age where you worry about things being held back from you. And third is, and this is, I think, the most remarkable feature of a blockchain, is once a transaction is recorded, you can't go back and really change any prior transaction because everybody can see changes when they happen. And if a change doesn't match what should be happening, that change will be rejected. So it's actually almost incorruptible. I say almost because I'm not sure whether there'll be somebody who's clever enough to find a way around it. But this is this to me is the most amazing part of cryptocurrency, is the architecture in which it's created. In effect, here's what you have with blockchain. Blockchain is digital. It's a digital way of doing intermediation, where the transactions are checked by the members of the network rather than by a centralized authority. If you think about it, much of the financial service business is built on intermediation, right? And the banks, the insurance companies, the investment banks, the stock exchanges, they get paid for being the intermediaries. Now you can already see why blockchains scare these traditional entities. Because if blockchains catch on, and if the transactions cost, and this is the big if the transactions cost of getting transactions verified on the blockchain turn out to be cheaper than what we use traditionally, this could displace large components of the financial service business. So guess what? The traditional financial service companies are very interested in blockchain technology. They're trying to co-opt it to make it work for them. We'll see how this plays out. This is it's a part of that fintech revolution you might have been hearing about. Now let's think about, though, whether cryptocurrencies have really succeeded. They've succeeded in terms of their prices going up, but ultimately it is a currency, right? So let's step back and think about what it is that we need currency for. So let's do some money 101. There are three roles that currencies play, or three purposes that they have to accomplish. The first is, it is a unit of account. What does that mean? I have to be able to value assets, value goods, value services, and currencies allow me to do it. So first, it has to be unit of account. For it to be a unit of account, the currency has to be fungible. In other words, one unit of the currency has to be exactly identical to another one. It's got to be divisible because I've got to pay with half of the, 1/4, 1/8. And when I add it all back, it should go back to being a full currency unit, and it should be countable. So you can see why fiat currencies operate very well as units of account. You can see why gold operates as a unit of account because, you can pay in ounces, you can pay in pieces, I mean, it's more, it might not be as convenient, but a unit of account allows measurement. Diamonds, for instance, don't quite meet the standards because it depends on the carats. It's not as easily usable as currency. The second is it has to be a medium of exchange. Why do we need currency? We need to do transactions. I need to buy stuff, sell stuff. And to be a medium of exchange, your currency has to be easily accessible and transportable. So part of the problem with gold is if I want to do transactions with gold, it's much more onerous to carry around gold to finish a transaction, especially if it's a large transaction, than paper currency. And it has to be accepted by buyers and sellers as legal tender. There's an element of trust, especially when it comes to fiat currencies, that when somebody looks at a dollar, they accept it as legal tender. And third, it has to be a store of value. What does that mean? If I set aside some of my wealth in that currency, I don't want the purchasing power of what I've set aside to deplete. And I think that's always going to happen to the fiat currency because there's inflation. Well, as long as I can find ways to invest the money in an interest-bearing account that covers the inflation, I'm okay even with the fiat currency. But I need something that preserves the purchasing power. So unit of account, medium of exchange, store of value. So let's think about traditional currencies. Traditional currencies can take one of three forms. They can be physical assets: gold, silver, diamonds, shells. Remember in the old, in the old days, there were other things, pieces of rock that might have gone as a physical asset. The second is it can be a fiat currency, usually a currency it's paper currency and coins issued by a government or a central bank, which is the extension of the government, and backed by the trust that you have in the government. There's nothing else. After all, you take a dollar bill or a rupee bill or it's just paper, and the only thing that holds it up is trust. Or you can have crypto or digital currencies. So basically, currencies can take one of three forms. Gold, much as people like to dump on it, has been around for as long as people have been trading for goods. And its long tenure as a currency, I think, can be attributed to the fact that it lasts forever. That it's, we seem to recognize it as something valuable pretty much everywhere in the world. So it's acted as a store of value for people, even when they've lost faith in every other type of currency. It's not a great medium of exchange, but it works, especially on large transactions. And it's not a great unit of account because it doesn't easily divide. It's not as convenient, but it clearly has. You got to give it the credit of having the longest tenure. Fiat currencies, though, you can see because they rest on trust. The strength of a fiat currency can vary across fiat currencies. The U.S. dollar is a fiat currency. The Swiss franc is a fiat currency. So is the Venezuelan bolivar. You can already see that there are some fiat currencies that are very good units of account, very good measures of mediums of exchange, and very good stores of value, and some that are abysmal. That's why I think the argument of whether something is a currency or not misses the point. Currency is a continuum from really good currencies to really bad currencies, and the question is where in that continuum does cryptocurrency fall? So, excuse me. So let's think about cryptocurrencies' strengths and weaknesses. It works as a unit of account. I don't see any reason why you cannot measure things in Bitcoin or Ether. So I think that's the easiest test. The weakest link to me in the cryptocurrency movement is that it hasn't caught on as a medium of exchange or as a store of value. 10 years after, or almost 9 years after Bitcoin came into existence, it's remarkable how few transactions happen in Bitcoin. There's all this hype here about Bitcoin. I remember reading news stories, 100,000 retailers accept Bitcoin. Well, really, I mean, if you take the 500 largest online retailers, I think last year 3 of them accepted Bitcoin. There's all these stories, but what about the fact that I read that Overstock and Microsoft accept Bitcoin? Well, not really. They accept Bitcoin as long as there's an intermediary who will convert the Bitcoin into US dollars for them as you come in through the door. That's not accepting Bitcoin. I will believe that Bitcoin has become a medium of exchange when I go into a store and I see prices in Bitcoin and I can actually pay in Bitcoin without an intermediary. And that doesn't seem to be happening. And the question is why? What's stopping cryptocurrencies from becoming successful currencies? I have my own views, so I'll put them down. I think there are 3 reasons. First, of course, is inertia. I mean, fiat currencies have been around a long time. We're used to spending paper money. It takes a long time to step away from what you've always done. That said, though, remember 10 years ago, if you had to take car service, you took a yellow cab or you took your own car. Now, think of how many people take Uber. 10 years ago, there was no, 20 years ago, there was no social media. 15 years ago, if you talk to your mother about some social media, you'd have had no idea, she'd have had no idea what you were talking about. Think of how quickly people have shifted into ride sharing and social media. So inertia is not as strong a force as we often make it out to be. So inertia, if it's a reason, can't be the primary reason. The second, and I think this is a big factor, is if you look at that, remember those graphs I showed you about Bitcoin and Ether? What made them really exciting to traders was how much their prices could move forget about in a week, in a day, in an hour. That's a good thing if you're a trader, but it's terrible if you're doing transactions. Can you imagine running a store, or having a store where you put prices up in Bitcoin and Bitcoin drops 25% during the course of the day? That wouldn't be a great characteristic if you're doing transactions. So the price volatility that has made Bitcoin and Ether so attractive to traders has made it unattractive to transactors. And finally, this game is young. There are all these competing cryptocurrencies. I've talked about Bitcoin and Ether, but they're just two of dozens. We have no idea. Every one of these currencies claims to be the winner, found the magic bullet to succeed, but we don't know. And if you're a transactor, maybe the reason people are holding back is they want to see which one emerges as the winner before they jump on the bandwagon. So all three forces are working against the transactions, but it basically means that there's a disconnect. There's a disconnect between what the market thinks about Bitcoin in terms of the prices and what the transactors are doing with Bitcoin. And this can be best illustrated in this graph. What I have in this graph is the price per Bitcoin from 2012 to 2017. The price of Bitcoin, if you'd invested $1 in Bitcoin at the start of 2012, it would have been worth $1,026 on July 29th of 2017. That's a 1,000-fold increase in the price of Bitcoin. Over that same period, if you look at the number of transactions done in Bitcoin, they increased only 32 times. The price has increased more than 30 times more than the transactions have increased. So the market seems to have taken off, but the transactions are not happening. So you're saying, how do you explain this disconnect? There are three possible explanations. If you're an optimist about cryptocurrencies, here's the explanation you will get. The market is a forward-looking instrument. So it sees success coming and it's pushed up the price because it thinks that transactions will happen, even if though they're not happening now, that they will happen in the future. Perhaps. I don't think so, though. And here's why. I draw a distinction between the value game and the pricing game. In the value game, you attach a number to an asset based on its fundamentals. In the pricing game, you attach a number to the asset based on demand and supply. And I would argue that cryptocurrency, if I look at the cryptocurrency markets, I am actually not seeing a value game. People are not asking questions about transactions and fundamentals. Or is this a good currency? They're playing the pricing game. They're buying and selling because they think the price will go up. It's a mood and momentum driven. And if you don't believe me, go into any message board where cryptocurrency traders hang out and look at what they're talking about. They're not talking about transactions and how much. They're not talking about the fundamentals as much as they're talking about charts and how cryptocurrencies are going to move in the next week, the next month. It is being priced, not valued. There is, however, an underlying factor that I think explains why cryptocurrencies have become so priced or so pricey in the last 8 or 9 years. We live in an age where we don't have trust. We don't have trust in governments. We don't have trust in centralized authorities. You see this in polls. You see this in elections. Clearly, something is happening under the surface that is making us trust centralized authority less than we did. In the old days, when you stopped trusting governments and you stopped trusting authority, you know what you did? You got rid of your paper currency and you bought gold. For a long time, gold was the only game in town. You could argue that now if you're 25, 30, if you're a young person, you have lost trust. And on top of that, you add the need for privacy and you're a little bit of paranoia on top. You can see why cryptocurrency can very quickly become your version of gold. And I think that is a big reason why cryptocurrencies have taken off, is you have enough people who feel, not just that they don't trust governments, who feel this worry about privacy and centralized authority, that they're willing to put their money in these cryptocurrencies. So now, let's take a closer look though. We've talked about cryptocurrency being a young person's gold, but there is a difference that they should be aware of. Gold has had staying power. It's been around for, as I said, for hundreds and hundreds of years. So when you put your money in gold because you worry about paper currencies, 10, 20, 30 years later, if you try to sell that gold is still going to have value. Gold is not going to go away because it's always been around. But let's say you put all your money in Bitcoin or in Ether 10, 20, 30 years from now. Are you sure it is going to be around? And that, I think, is a question you got to ask. And to answer that question, you know what you need to address? Will it become an accepted currency? A cryptocurrency that never gets used as a currency in transactions will not survive. It cannot make it in the long term. There can be no good ending to that story. So the real question you got to ask is, if you're putting your money in Bitcoin, you can play the pricing game, but you also have to ask the question, will Bitcoin make it as a currency? And that's really the question that I want to address, because I think that if you look at why cryptocurrencies have not succeeded, I put the fault as much on the creators and promoters of these currencies as I do on the transactors. In fact, I put more, because if you look at every pitch you hear about why cryptocurrencies are good, the pitch is to the traders, not to the transactors. People talk about how much Bitcoin has gone up or how exciting it is to be in the market, rather than how it's a good currency for transactions. And the design of these currencies seem to be, again, more directed at traders than at transactors. For instance, many of these currencies have caps on them. And if you look at the rationale given for caps, it's to protect traders so the price won't collapse. What about transactors, right? I mean, in a sense, I'd like to see a currency where the constituency that the currency is aimed at is not traders but transactors. And finally, I know that many of the people who hold cryptocurrencies, transact in cryptocurrencies, trade in cryptocurrencies, are driven by a loss of trust in centralized authority. And trust me, that's a bad use of word. Trust me, I share your mistrust in centralized authority, but I'll also tell you that if you have a currency, you need trust in something. So you need to find whatever you're going to trust in, because a currency cannot exist if you trust no one. And a currency cannot exist if you make it all about decentralization and privacy as the centralized features. You might have to compromise on privacy and on centralized authority for a for a cryptocurrency to work out, because ultimately you want it to be effective as a currency. Now, one final point about cryptocurrencies that I think is really going to be an acid test for them. Right now, I told you that if you're a Bitcoin miner or an Ether miner, and you succeed in verifying a transaction block, you get paid with Bitcoins or Ether. And the reason you're able to do that is you have slack in the system. What do I mean by that? Bitcoin actually has a hard cap of 21 million Bitcoin. Right now we're at about 16.5 million. So you can afford to hand out Bitcoin to miners because there's still slack in the system. What happens as you get closer and closer to 21 million? After all, miners are not going to put in the time and the resources if they don't think they're going to be rewarded. Right now, if you talk to proponents of Bitcoin, their argument is, hey, you know what, transactions costs will cover it, or technology will shift. I'm sure the technology will evolve but if this is a currency, don't we need some serious thought about how big those transactions costs are, whether technology will evolve enough that the transaction costs are low enough for Bitcoin to actually make sense? What if the end game is that the transactions costs with Bitcoin are just too high in steady state? Then what? Then you've invested in a currency that cannot be used as a currency. So I think we need some serious thought about, in steady state, which of these cryptocurrencies is most likely to become a successful currency. So one final point about the pricing of these currencies. I mean, after all, I'm in valuation. I'm probably saying, why didn't you can't value currencies. You can price them against each other. That's called an exchange rate. And if you think about what drives the exchange rate between fiat currencies, it's very simple. They should have roughly the same purchasing power. In other words, when I say a dollar is worth $1 is worth 0.8 euros, I'm effectively saying I have roughly the same purchasing power with a dollar as I do with 0.8 euros. So that's called purchasing power parity. It is an imperfect but an extraordinarily powerful way of explaining exchange rates. You're saying, what's that got to do with Bitcoin? That 2007.75, that was the price for the Bitcoin at the start of on August 1st of 2017. That's actually an exchange rate between US dollars and a Bitcoin, right? And if that exchange rate is right, I should be able to buy $2,775 worth of goods and services with a Bitcoin. Can I do that today? Of course not. Why? Because most people are not even selling their goods and services on Bitcoin. Does that mean Bitcoin is overpriced? Not necessarily. If you believe that Bitcoin will succeed as a currency, Remember, there are only 21 million Bitcoins that are going to be around in steady state. You could get to 2007-75. So if you believe that Bitcoin will make it as a digital currency, and that's why I focus so much on will it become a currency? What does it need to do to become a currency? 2007-75 you can live with. But if you don't believe Bitcoin will make it as a currency, you're playing a shell game. That $2,775 is really just a pricing game. You just at least be honest with yourself about what you're betting on. So the bottom line is digital currencies are not here yet. Cryptocurrencies have succeeded in the marketplace in terms of pushing up their prices and their market capitalization. They haven't succeeded as currencies in the transactions game. But I'm an optimist on digital currencies. I don't see anything that fiat currencies have that gives them a monopoly. I don't think governments are somehow more solid than any other entity. So I think digital currencies are coming. But for digital currencies to come, they've got to be focused on the currency side, not on the trading side. They've got to be focused on making it easier for people to do transactions with it. And I'm not sure. And if you ask me which one of the existing cryptocurrencies is doing that, as I said, I'm a novice on this, but I don't see any of them standing out on the transactions line. One of them might be able to step out from the pack and be able to do something that makes them, more attractive to transactors, or maybe it'll be somebody new that we haven't even seen yet. But whatever it is, I'm excited about the coming cryptocurrency. So I'm glad you were able to hang in here with me, and thank you very much for listening.